In today's session, we would be discussing marginal costing. Previous sessions, we had discussed methods of costing. In the previous sessions, we had learned what is meant by methods of costing. So some of the earlier methods of costing that we learned was, job costing, process costing, composite costing, etc. Okay? But now we will try and understand why does a business need to apply methods of costing. Method of costing gets applied by a business so that they could ascertain what is their cost of production. Any business is in the activity of converting raw materials into finished goods. In the due course of converting the raw material into finished goods, they may be having different types of costs. They would be incurring different types of costs. We saw some of the classifications of cost in the previous sessions. So they would have direct costs, they would have indirect costs. Now, indirect costs, it could be at the factory, it could be at the office, it could be as a part of your selling and distribution, and then we would end up classifying them, and then we would end up trying to find out what is the total cost. But why are we trying to estimate the total cost? We are trying to estimate the total cost because we would like to know what is our cost of production. Okay? We would like to know what is our cost of production. So why is it important for a business to know its cost of production? It is important to estimate your cost of production because your certain key business decisions are taken based on your cost of production. Okay? Your certain key business decisions are taken based on your cost of production. So looking at that, it is very essential for you to fix a price for your product. Okay, you have to fix a price tag for your product because you're in the process of manufacturing finished goods. You're in the process of rendering services. But when you make your product available to your end customer, or when you render your service to your client, it is very important for you to fix a price band for that. So that is done with the help of method of costing. You're able to understand what is your total cost that is involved, and based on that you're able to assign a price for your product. Now, also it is based on the price of the product that you have to fix your profit margin. Would you like to take 5% as your profit margin, or would you like to take 10% as your profit margin? So if you look at the hotel industry, for most of the cases, what happens is their profit margin is around 40%. Okay, so which means if 60 rupees is their production cost, then they will have to sell it at 100 rupees so that they will make a profit of 40 rupees. So that's what happens in the method of costing. So now the method of costing that gets applied, it will depend on your manufacturing process. It will depend on the nature of industry that you're involved. Are you into service? Are you into production? If you're into production, what type of a production are you into? Are you manufacturing food? Are you manufacturing FCM or FMCG? So depending on the category of product that you're dealing with, you will have to go about depending on a method of costing. So that's the reason why it is very important for you to determine your method of costing. Okay? Now, in that line, there are some very important methods of costing that I would like to discuss with you. Okay? There are some very important methods of costing that I would like to discuss with you. So some of the methods of costing, I would not be discussing all of them. I would be discussing some of the prominent ones which are used in the industry or by the businesses. So the first one is called as historical costing. Okay? The first one is called as historical costing. So here, historical costing, what happens is you decide the price of your product after the entire activity has been completed. Okay, so let's say you are into production process, and then you would go about carrying out your production, and once your production is complete, then you would go about assigning a price tag for your product. Okay, so typically if you look at the unorganized industry, also for example, if you go to a carpenter, okay, and then you would like to make a fancy sofa. Okay, and you're giving him maybe an out of a box design. So what the carpenter would usually do is he would give you an estimate. Okay, he would tell you, okay, it should cost you around maybe 20,000, or approximately it'll cost you around 30,000. Then the carpenter would go about carrying out the actual activity. Once the furniture is ready, then he will give you an actual price tag for the product. So this is historical costing. So here you have to complete the activity for you to assign or for you to determine the cost for your product. Okay, so for here what happens is you have to complete the entire activity for you to give a price tag for your product. So that is called as historical costing. Okay, now historical costing, what happens in historical costing is the advantage is that you can give a perfect, you can tell the exact price, because you are able to complete the activity and then you're deciding on the price tag. But the disadvantage is also that in historical costing, sometimes it may be ambiguity. There may be a lot of ambiguity for the customer. Customer would not know what would be the exact price that he will have to pay. So that's a disadvantage of historical costing. The next type of costing is what is called as standard costing. So what happens in standard costing is the cost is set as per certain industry standards. Okay, the cost is set as per certain industry standards. So based on that industry standard, irrespective of your cost, you would go about deciding the price for your product. So for example, if you walked into these darshanis, okay, so like Sukh Sagar, or you go to Adigas, or you go to Balaji, or you go to these darshanis, what happens is most of the cases the meals or the cost of the food items would be fixed. So for example, if it's like 50 rupees, any darshani that you go to, the price would be more or less the same. So what are they doing? They're following standard costing. Okay? So the costing is fixed across that category of hotels. Okay, so that's what happens in standard costing. So it is based on certain set industry standards. Then you have absorption costing. Okay, then you have absorption costing. So then you have absorption costing. So absorption costing, what happens over here is the fixed as well as the variable cost is passed on as a part of the price tag for your product. So what you will have to do is you have to figure out what is your fixed cost, then what is your variable cost, add them up together, divide it by the number of units that you have produced, and then you know what is your cost. So in absorption costing, what happens is the fixed cost of producing the product, the variable cost of producing the product, it is both absorbed from the price of the product or service that you're rendering. So that's what happens in absorption costing. Okay, that's what happens in absorption costing. But absorption costing has got a certain disadvantage. The disadvantage is with respect to fixed costs. Okay, recovery of fixed cost. So for example, imagine I have invested into a factory. Okay, I'm invested into a factory and I started manufacturing a product, and after 1 year I decide to change my product line. I brought another product line. Okay, so then what happens? What happens to the cost of the money that I've spent in creating the infrastructure? Okay, so if you look at especially electronic goods, okay, electronic goods, what happens is the factory or the manufacturer or the company, they would be reusing the fixed infrastructure facilities. Okay, so for example, if you have MI. Okay, so MI, when they started off, they had product lines like Redmi 3, Redmi 4, Redmi Prime. So these are some of the product lines that they had, but they're not continuing with the product line forever. So after a certain period of time, they would give up the old product line, they would switch over to a new product line. So for example, right now the latest mobile phone that you have is Redmi 9 and Redmi 10 series. Okay, but it is being manufactured in the same facility which was utilized for manufacturing the earlier brands of or the earlier variants of Redmi. So what has happened to the fixed cost? What has happened to the fixed cost of creating the infrastructure, buying the land, setting up the factory, buying the machinery. So whenever a new product line is coming, what would happen is they're just reconfiguring the machinery. Okay? They're not changing the machinery entirely, they're just reconfiguring it. So in such cases, how do you recover your fixed costs? So absorption costing has got that disadvantage. So to address all this, we have what is called as marginal costing. Okay? We have marginal costing. Okay? So marginal costing, we would be discussing in detail in the coming sessions. Okay? We would be discussing in detail in the coming sessions. So let me just do a recap of what I've done. We saw that we spoke about methods of costing. We saw that methods of costing are very important because the price, it is very important for you to estimate your cost of production. Based on that, you will end up fixing the price of your product. And then we discussed some important methods of costing. We saw historical costing, we saw standard costing, we saw absorption costing, and then we would be eventually learning marginal costing as well.